Time now for an in-depth look at the market news this afternoon, and for that I'm joined on the line by Mr. Daniel Yu, Global Strategist at Yuanta Securities. Mr. Yu, good afternoon. Thank you for making time today.
Good afternoon.
Well, let's start with that historic inflation in the U.S. The Consumer Price Index last month was up 7.5% from a year earlier. That would seem to fuel expectations for more aggressive rate hikes by the Fed. Even excluding food and fuel prices, core inflation was also up by the most in 40 years. Tell us about the situation, Mr. Yu, and what you make of it.
Yes, if you look at the annual inflation for U.S., it accelerated to 7.3% in January, YOY. That is highest since the February of 1982, and it is much higher than the market forecast of 7.3%. It seems that all areas show quite significant price rise, including the energy prices as well as shelter, food at home, new vehicles and used cars and trucks, and even Medicare services. All in all, it seems to show a significant rise, and also the core inflation was up by 6%. Forecast was 5.9% and accelerated as well. Now, with this, Fed rate hike expectation has increased significantly. As of March 16th, more than 90% are expecting that it will be not just 25 basis point hike, it will be 50 basis point hike. And also by end of December this year, anticipation for more than 6 times rate hike is more than 90%. 7 times rate hike is also above 90%. So clearly, speed of the rate hike is expected to be accelerated going forward. And this has resulted into overall market volatility at the current point in time. However, if you look at the YOY number, the last year's first year, second year inflation, the consumer price index was coming in at lower than expected. So therefore, the base effect is happening, and therefore the peak number will be coming through in January and February, and most likely the March numbers will start to show quite a bit of decline going forward. So yes, right now people are quite concerned about the rate hike at a faster speed, but as the time passes by, the level of the rate hike is not going to be that significant to the level that it will be 7 times this year. Most likely the pace will be once every quarter. Based on that, we think that the above 2% Fed rate will be reached sometime end of next year. And the Fed raising interest rate above 2.5% is very unlikely given the high level of debt of U.S.
That seems like in line with what we were hearing from the Fed, several weeks ago. And with those inflation numbers, stocks on Wall Street closed quite a bit lower on Thursday, pretty much wiping out the previous day's gains. Another factor is the 10-year Treasury yield rising to above 2%. What's the story in the global markets?
Yes, it was actually surprisingly that the market has risen in the previous 2 days before the rate expectations or the interest rate, the inflation numbers. As you know, the Nasdaq rose 1% 2 days ago, and then 2% 1 day ago, and then just today the U.S. market fell by 2%. So it did fall less than what has risen in the last 3 days or so. Now, what you look at that is that market is already taking in quite a bit of a rate hike already, and that people are quite used to hearing high inflation numbers and rate hike factors. And that has resulted into a decline of the share prices, but not to the extreme that we saw before. It was like 4.7% drop in 1 day and then recovering very quickly. So huge volatility. The level of the volatility has been reduced at this point in time. The reason why the market fell towards the afternoon yesterday, the reason for that is because the St. Louis Fed President James Bullard said that U.S. need to raise interest rates quickly as possible, and by July, rate needs to be raised to 1% plus. So he is the most hawkish Fed person, and that's the reason why the market kind of took a bit of a negatively. However, he is only one person. We think that the rate hike speed should be once again probably 4 times this year, next year another 4 times. If that's the case, we don't think that the market can stabilize. We think it should be stabilizing in the future. One concern, however, though, is the 10-year government bond rate and also 2-year government bond rate has risen quite significantly, and that the differential between 10 and 2 years has fallen to 0.45%. We think that trend is a bit of a negative. If that number turns to negative number, then we think that the economic recession will be happening within, after that, of 1 year, and that market would expect to show quite significant drop going forward. So we need to keenly watch what happens to this 10 minus 2 years government bond rate differentials.
And the volatility continued in Korea today as well. Stocks lower by a pretty significant margin. A much bigger decline on the tech-heavy Kosdaq, though, down 2%. One standout was the company Krafton, which had its big IPO last year, and its shares were down by double digits today on a decline in earnings. Tell us about the domestic market.
Yes, if you look at Korea, it's a similar trend where the interest rate rise is affecting negatively. Any growth stock will be negatively affected if the earnings are not coming through, the sales numbers are not coming through. As you said, the Krafton share price fell quite significantly, and the reason for that is because the fourth quarter earnings is a pretty much a shock. And also, if you look at WeMade, also it's the same thing, excluding the cryptocurrency-related earnings, actual earnings were dropped quite significantly. So higher interest rate environment, you're not going to have any company showing a rising trend in share price if they cannot prove that the sales growth rate and the profit numbers growth rate is coming. If it doesn't come through, then obviously share price will fall. So if you look at the overall market, the Kospi has went down by 0.87%, and Kosdaq was down by 2%. Clearly, the Kosdaq is the one high growth names, and with the volatility related to the interest rate can be quite significant. So therefore, we think that this kind of trend would continue to happen. If the Kosdaq in the future stabilizes, then that means the earnings numbers will be stabilizing as well. For the time being, uncertainty continues to remain. But one positive factor is that Kospi-wise, foreign investors are increasing their net buying, and they net bought 377 billion today. And most of the very large cap names are showing very strong numbers in earnings. So therefore, ROE numbers are going up for Kospi, and that means that the Kospi at least should be stabilizing despite this concern of the liquidity reduction.
Well, finally, Mr. Yu, today we see the exchange rate for the Korean won right at about 1,200 to the dollar, just slightly below that. The dollar's been strengthening against the won for the past year. So tell us about that, and with what's happening with interest rates and a potential differential there, where you see the exchange rate going.
Yes, I think that what we need to look at is what's happening to the Fed stance and also U.S. interest rate environment. If the Fed raises interest rate as quickly as what market expects, then the dollar should be strengthening quite significantly. And if that's the case, then Korean won should further depreciate. However, though, we are saying that the interest rate hike will be in a speed where the market can expect a certain level of speed, and therefore U.S. dollar strengthening is not going to be that significant. So therefore, we are looking at about $96 index. Most likely, if it goes up, it's not going to reach above 100. So if we look at Korean won, it has reached 1,200, but it's not going to be depreciating further that much. I think that at most we're looking at 1,300 in a longer-term basis. So I think that that kind of trend is actually quite reasonable in that the Korea's exporters can be beneficial for that kind of exchange rate. Only concern would be what's going to happen to the inflation number for Korea, that Korea imports quite a bit, and if you look at the import-export numbers, import growth rates are coming in very significantly as the exchange rate depreciates. But nevertheless, all in all, we think that export number being strong is more important for Korean economy as a whole, given the fact that the export-related and manufacturing-related segment of the GDP is very significant for Korea, and a highly export-oriented country that we are. And we think that the currency depreciating in a speed that can be expected, that could be quite positive in terms of the overall economic growth numbers.
Got it. All right, Mr. Yuba, leave it there for today. Thank you as always for sharing your insights with us, and have a great weekend.
Thank you very much.